Hi there. I'm doing this video because I think it's important at this stage that people understand just how dangerous the current situation in the markets is. Not because I want to argue with the bulls. People who have been following me for a long time know that I've been bullish, well, for years and years and years. And I turned bearish in October. I turned bearish for reasons. And the people who don't see the reasons are also the people who will be selling out last because the market will just force them to. It's important that people should understand that markets do not trade randomly. That is that's just silly. The way markets trade is on a spread basis, one asset against another, which, if you think about it, makes sense because you reposition at times your portfolio. You sell something to buy something else because you think something is going on. If you think that nothing is going on, you leave things very much as they are and you let them ride. Now, I've traded this way for the best part of 35 years. I was taught by the best guys at Sally's back in the 80s about spread trading, butterflies, and things like that. And then I built my model, which basically tells me when we are in risk on and when we are in risk off. At the moment, the model is very clear. It broke down. It is, at the moment, the model score is minus 47. It was the day before was minus 43, minus 47, minus 53. And if you have a look at these at these prices that the score is producing, they have not been negative ever since the basically here we are talking about 2015, that kind of time frame. What they are telling me is that we're in a very, very dangerous period, and that this will not be a quick V-shaped bottom and the market is going to go up. We are much more likely to have a period just like 2014, 2015, or even a 2011, 2012. And if we are very unlucky, and I think we might be, we're going to get a 2007, 2008. Now, I want to show you some charts. I mean, this I'm just showing you because this is the end result of all the charts I'm going to show you next. This is a distillation, a score which comes up as a result of all the other charts I'm now going to show you. And if you still think that the market has a chance of going up after you've seen those charts, well, then I haven't done a very good job trying to persuade you. Now, I have hundreds and hundreds of spread relationships that I look at, and this is probably the fastest indicator that I follow, which is basically the semiconductor index against the Japanese yen. The Japanese yen simply because it is a funding currency, and when you need to fund a risk-on position, that's where you go to. So if you have a look at what happened in this period between 2015 all the way to 2016, it was in a mini bear market with the NQ as resulting in a small retracement, and then in July, August of 2016, it gave a very strong buy signal, and it has been in a buy signal ever since. And now in October, it gave a sell signal for the first time in what is it, 3 years? So this is the reason why one turns bearish, not because one feels bearish, but because the spread relationships are starting to break down. The 200-day moving average is now underneath the 50-day moving average. This spread relationship is breaking down, which is saying that people are getting out of the positions they put on here. Whether they're going to go short or not is something completely different. But there are hundreds of these spreads, and they're all turning negative, every single one. Now, this hasn't happened since 2007. The spreads turned negative in the middle of 2007 to actually beginning to middle of 2007 and remained negative while the market did nothing but go sideways to up. And then in 2008, the market just fell apart. This is what these spreads are telling you. They're telling you this market is going to fall apart. Now let's go and look at them one by one. Okay, this is SHY, which is the shortest, two to 3 year ETF. So 2 to 3 year treasuries against the SPY. Just like the previous chart, it gave you a very strong buy signal here. So in the early part of 2016, and ever since then, the market has been in a risk-on position, and at the moment it's beginning to be in a risk-off position. Ask yourself why, when the Fed is hiking rates, and how many Fed hikes have we had now? The shortest part of the curve is beginning to outperform the equity market. Now that to me is shocking. Let's move on to SPY against IEF, which is 7 to 10 years. Again, here we're breaking down, and probably we will go and test this support line. So the 2 to 3 year area, the 7 to 10 year area are all breaking down against the SPY. These spreads are all beginning to go negative. They all went positive back in 2016, and they've remained positive ever since, telling you stay long of equities, stay out of bonds. Now they're telling you to do exactly the opposite. And this is not something which changes every couple of days. This is something that's going to last for months. The only part of the yield curve which has not given a sell signal is actually TLT. That's 20 years. That is actually frightening, because what it's saying is that the yield curve at the front end is going to collapse, and TLT is likely to stay in a range. That is telling you that we're going to have a very steep yield curve, between say 5-year and 30-year, and that is the worst of all possible worlds, because equity prices discount against the longest part of the curve. This is as bearish for equities a scenario as you can possibly imagine, and it's probably not one that I've seen since the mid-80s. And this is the spread between 5-year notes and 30-year notes in terms of yield. You can see that it has been bullish ever since 2016, saying basically the yield curve is going to flatten, the yield curve is going to flatten, the yield curve is going to flatten, which is bullish for equity prices. Look what happened in October. It's just fell apart, and it's now about to give a sell signal. 50 going to cross the 200-day. This to me is probably going to go another 20 basis points, 30 basis points at least, which is telling you that the 5-year note, the belly of the curve, is going to outperform the 30-year note. That to me is signaling something which is unknowable at the moment, but it's signaling something very, very dangerous for equity prices. Now, if we look at the internals of the market, and this is XLP over XLY, XLP basically is your standard equity which produces some kind of a yield, your necessities of life, your food stocks, your drugstores, all that boring stuff, against XLY, which is consumer durables basically. Here we are again. Today we made a new high in XLP XLY. This market gave you a wonderful buy signal back in 2016. It said risk on, baby, and this is it. Do you see it? Back in the middle of 2016, this said get some risk on board. Just like all the other charts that I've shown you, mid 2016, they all said risk on, and now they're all saying risk off. When these things happen, they don't last a week or two, a month or two, they last a long time. They will probably last a year to 2 years. That is the kind of time frame that you should be thinking about. Okay, so this is XLY over SPY. Now, if we really are having the most wonderful time for the consumer in the United States since God was a boy, as Trump keeps on telling us, why is XLY underperforming SPY? Why? I don't have the answer to that. I can just tell you it is. This chart shows it very, very clearly. It is quite possible that in the next few days we get a sell signal here as well. We make new lows, we've made some sort of inverse head and shoulders, and we collapse back down to where we were in 2017. So what does that mean? That means that prices are going to go back to where they were in 2017, which is around 2400. Another shocking chart, and believe me, I'm not cherry picking. There isn't a single one which is good. But this is really shocking. This is the Dow against QQQ. So basically this is the safety of Dow stocks, of boring stocks, against the high beta of the QQQs. People who've been following me a long time will remember that I tweeted right when it touched there that I was getting out of every single high beta stock. And look what the market has done since. It is now ready to turn the 200-day moving average. We might quite easily come back from here for the next couple of weeks or something like that. But at some stage, I am absolutely convinced it is going to trade back up here in the 160s. Which basically means that even if S&Ps go down only 5% or 10%, the Nasdaq is going to get destroyed. It's going to go down twice as fast and far. So there isn't a single spread, and I'll go through them all, that is positive at the moment, and it is something which you should really, really be worried about. There is still time to get out. Just do it. Now, this is probably the most dangerous chart there is out there. And this is basically the blue line is the difference between overnight money and 5-year money. What are banks? Banks are nothing but machines that basically transform overnight money where they borrow into 5-year money where they lend. So they want to have a nice big positive spread between overnight and 5 years. The wider the spread, the more money a bank makes, unless it lends badly and then they never see the money back again. But assuming that they're doing their job properly, the width, you want this blue line to be as high up as possible. While this line is XLF, i.e. financial companies, banks and things like that. The spread now is coming in to the lowest it's been since 2012. And if I'm right and the 5-year note keeps on outperforming the belly of the curve, you're going to have the situation where 5 years could be under, i.e. have a negative yield against overnight money. In that case, XLF, which is 20-odd% of the S&P, is going to get killed. And I don't mean it's going to come down 5%, it's going to come down probably to at least here. Okay, so from 24 to 17, you know, it's going to come off by 20 plus percentage points. That is the danger. That is how dangerous this market is. Now, this is the old world index against the S&Ps. Basically, the S&Ps have been outperforming the old world up to now. You know, could they continue outperforming? Absolutely. They've done nothing wrong. But I'm just saying that a market which has moved something like 40% already in favor of S&Ps is unlikely to move much more. It could do. I'm not saying that this is a bullish chart by any stretch of the imagination. I'm just saying that the danger is that it doesn't. And if it doesn't, it has an awful long way to come back up before, you know, there's any resistance to it. So this chart to me actually is stating that the danger in S&Ps is even greater than the danger in anything else. The drivers of the expansion in S&Ps have been XLK and XLY. XLF has helped to a certain degree, but the two components which have really been the stars have been XLK and XLY. We already looked and we saw that XLY is breaking down against everything. How is XLK doing? Exactly the same. It's breaking down. Could we go and retest these levels around 0.24, 0.23? Yes, easily. That would mean that the NQ would probably fall between 5 and 10% more than the S&Ps would fall. And we've already seen what the big danger in the S&Ps is. So the danger in NQ is absolutely colossal. Are we at a stage where we should just man the lifeboats? Not yet. This is the S&P against gold, and it's still holding in. It's still holding in, but it's nowhere near as strong as it was a few months ago. And I would not be surprised to see it trade back under these moving averages and come back down to the 21 level, which basically means that there is very little support for equities from other asset classes that need to be sold for equities to be bought. To me, this is another bearish chart. It's not that bearish. It's not telling me get out of absolutely everything. I've already showed you where you should be out of high beta stocks, but it's not telling me to get out of the the really boring day-to-day stocks, XLP, that kind of stuff. So that's not telling me that, but it's telling me that we are in a very dangerous position for all the other sectors. Finally, I want to show you volatility, which is another component of the model, because volatility is a great predictor of equity prices. And on a daily basis, okay, we're not in a sort of terrible place, but we have, for the first time since beginning of 2018, we have turned the 200-day moving average, and the 200-day moving average keeps on trucking higher. Even throughout that period over the summer, when we kept on trying to make new highs in the S&Ps, this was telling you no, 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 and poof! And now that we're trading well above the 200 and the 50, I would not be surprised at all if at some stage we went and tested this 25 level. And if we do that, we are going to go a lot lower, certainly in NQ. If we now have a look at something which is even worse, which is this. This is the weekly chart, and we are now for the first time turning the weekly moving averages, and we are opening up the Bollinger Bands for moves up to 25-30. Basically, what the market is telling you here is that we could easily at some stage over the next few months trade at 43, and that is going to be pretty damn bad stuff happening. It's going to be flash crash. It's going to be 2007, 2008, that kind of scenario. So I've gone through most of the charts here, and I've looked at every single spread chart that I look at, and I've been bullish ever since 2010, and now I'm out and I'm trading exclusively from the short side until this actually returns back to positive, because this analyzes thousands and thousands of spread relationships, and it tells me whether the market is risk on or risk off. It is no good looking at the moving averages underneath. You have to look at, and underneath the markets themselves, you have to look at the spreads. What are the spreads doing? You saw what the market did today. It collapsed 30 points on nothing. And that is because the spreads are negative. When the spreads are negative, the path of least resistance for the market is down. Quite the opposite, when the spreads are positive, then the path of least resistance is up, and you want to be bullish. Now you want to own as little as possible in terms of equities, nice and safe equities, and you want to own the 5-year area in the bonds, just as it's indicating. So I'm not, as I said, I'm not doing this to argue with other people. I'm just saying this is the other side of the coin that nobody's showing to you. And I want to show it to you because I think it's really, really, really dangerous to be long at this moment in time.